Hello, it's Mike Doyle at the mortgage firm Wellington Lake Worth, and we are here again with Facebook Live, and it is our weekly Ask the Mortgage Lender Your Mortgage Questions. So I'm here with Elizabeth Lopez, been in this business for a long time, best manager Regions ever had, and I've got Tom Bennick, who is old school customer service. Tom will meet you at the bank, meet you at the house, whatever it takes, and we're here to answer any of your questions. We're going to talk a little bit about calculating income today.
Yes,
Go ahead, Tom.
ever-changing subject, an ever-changing calculation.
It's an exciting subject to talk about, but it's just so it's very everybody just has a different scenario, so it'll be interesting.
Yeah, the tough thing about income is there's a lot of ways to look at it. I mean, we don't run into a lot of people that are just, I'm salaried at $1,000 a week. I've been salaried for the last 5 years with my 2% raises. And, I've got the money in the bank. So we don't run into those scenarios so much. If you have a straight salary, you've got just hourly income and you got a straight 40 hours a week with no overtime, bonus commissions, it's pretty straightforward. Anybody can calculate those. But as you start getting into, variable, different types of income, they all come with different types of conditions. Mm-hmm. So we've got to go ahead and try and figure out and understand those conditions and whether your income is going to be consistent.
Yeah, and sometimes it's not just the your regular income, it's rental income, it's commissions, it's all the extra bonuses that we're able to add and how we come up with those numbers. It's not just based on whatever you receive at the time, or if it's rental, whatever the contract states, or whatever you're really getting out of it. So it's so many different types again of incomes that we could calculate, but we are given certain guidelines in order to do those.
Yeah, self-employment and is completely different than a W-2 wage earner, and it's completely different than, and then you get part-time income. Well, part-time income you can only use if you've been there for 2 years, I believe. So that's what we're going to kind of get into, a little bit of the details on how income is calculated. Sometimes we have customers, or I have customers that might show me their tax returns or their W-2s, but if they're no longer in that position, then I can no longer count that income. So even though that income might have been made from last year, that was an employer you had last year, you're no longer employed there. So again, we certainly can't include that income. So, look, if it was up to us, I think we'd give everybody $20,000 a month and keep everybody happy. But regretfully, we can't calculate things that way. Those days are gone.
Yeah, and a lot of the things that we ask for, even if you're not working in your current job, it is for employment history. Just because we do have to have a certain amount of employment history on file, but maybe we're just not able to calculate your income. So just know that if we ask you for additional information, it may not be to calculate income, but it is for the job history part of it.
And to follow up on Liz, it's 2 years. So it's going to be 2 years of continuous employment, and or 2 years of employment, and I was in school previously to being employed. So typically it's 2 years history.
And what I tell everybody is, it's not whether I think your income is solid, or it's not whether I trust your income. We plug your income into Fannie, Freddie, FHA, VA, USDA. It all depends. Everybody has a little bit different way of looking at the income. So we take what you have on paper, and if you don't have it on paper, it doesn't count. So if you're getting paid under the table, or you're not getting paid on something, it doesn't count. So it doesn't matter if you've never missed a bill in your life. If you're not showing the income, it doesn't count. So we tell people you just can't take it personal. We're just taking the information that comes into us. We're here to close loans. We want to help you. All right. We don't want to get somebody in a loan they can't afford, they're going to get in trouble with, but we're trying to get you the loan based off the information of what we're allowed to do for you. So the basics on income is it stable, and is it expected to continue for 3 years? So we have a lot of things, like if you're getting alimony, if you're not getting it for 3 years, I can't count it. Child support, if it's not coming in for 3 years, I can't count it. If somebody's paying you off on a note, we've got to see that you've been getting it and that it's going to continue for 3 years. So stuff like that with annuities, if you're taking distributions, regular distributions on IRAs or 401s, if you're 59 and a half, everything has got to be, can I see that it's going to continue for 3 years? And a lot of people will get frustrated at that, but I get stressed over the thought that I'm going to get you into a house, especially if I'm dealing with someone who's looking at child support or alimony, and then at the end of 3 years, the income stream stops. So we always want to know what's the plan at the end of 3 years, so you're not in trouble. Also, that 2-year history that we're looking for for the will it continue potentially for 3 years? And of course, there's no guarantees. We could all be fired in our jobs tomorrow. But also, do we have a previous 2-year history of working? So we like to see a 2-year history of working, or did you study something? Like if you're a nurse and you're in nursing school, and then you got out and you got a job as a nurse, we'll pretty much lend to you right off the bat. You could have had no jobs in your whole life, and then you got out of nursing school. We got 2 years of you in school, and you got a brand new job. You can go get a loan. So it's not as restrictive as some people think.
And the 2-year history also, we want to bring up that it's not, let's say, exactly like 2 consecutive years. If there's a gap, we still need to get the 2 years prior to that. So if I worked from, I don't know, July 2022 to July 2023, but then prior to that, I didn't work for 6 months because, I don't know, I was sick or whatever. Prior to that, what did I do? So that's what we go back on when we say 2-year history is, again, just the time that you were at work. We need to know work-wise, where were you for the last 2 years of work?
And just to elaborate on what Elizabeth is saying, a gap in employment is not unusual, and there's nothing wrong with the gap of employment. We just need to complete 2 years of employment, and then we can work on or explain or letter explaining what the gap was.
Right. And the other thing that I think I get a lot of is people that are told you have to be at your current job. If you're a W-2 employment, you have to be at your current job for the 2 years. I've had people in the middle. I don't recommend you do this in the middle of a transaction. Please don't do it in the middle of a transaction. But I've had people that go from a W-2 to a W-2. That's okay. I mean, if we're able to see like there's if you've just left one job and you go to another W-2, but maybe you're getting paid more, we may ask for additional information such as an offer letter and your first paycheck of your new employment. So it's not that you've got to stay at your same job for 2 years, because I have had nurses in the past that just maybe got a raise just to go to a better position, and we could do that as long as we have the consecutive years and you're going from W-2 to W-2, you're fine. If you have 2 years of work history but you're going from a W-2 and decided to open up your own hospital and decided that you're going to be now 1099, that's a big that we got to look at.
Yeah, going from a W-2 to a self-employed individual is a lot more challenging than going from W-2 to W-2. Again, once you're self-employed, you open up almost a new can of worms.
Mm-hmm.
All right, sorry I was jumping around a little bit. I was just trying to get a couple of other screens up for when we start calculating self-employed information. So let's go ahead and get back to this.
And again, calculating self-employed information takes an electronic and mathematic engineer like Michael, because you got to dissect tax returns. You got write-offs you can write off. You got all kinds of benefits you can write off as a self-employed person that a wage earner or a W-2 person does not have. So that's why it's a little bit difficult, narrowing down what a newly self-employed person's income is going to be, because you do have the advantage of getting those write-offs.
All right, we're going to look like simple, which we said there's not a lot of these. We get these as pretty straightforward. If you're making $1,000 a week, and you get paid for your holidays, you get paid for your sick days, you get $52,000 a year. So I don't care if you just got a raise to $52,000. I mean, look, if you were just making $20,000, you got a raise to $52,000. We're going to want to take a look at it, okay? But if you've been working at a place and it's solid, it makes sense, and you got a raise to $52,000, we're going to count $52,000. The same thing goes with if you're paid hourly, if you're 40 hours a week, because people might be 40 hours a week, but a lot of times you're out a lot, you're unpaid. If you're running 40 hours a week, or you're supposed to be 40 hours a week, but we're 6-8 months into the year and you're only averaging 30 hours a week, we're going to have a hard time qualifying you on 40 hours of income, unless we can see that, you're out for a specific reason. You had some time off without pay for a specific reason, unless we can start explaining those specific reasons, but it's got to be a solid reason for why we can do this. All right. But basically, we take everything and we break it down into monthly. So everything with us is monthly income. So again, the 40 hours a week, $20 an hour, 52 weeks a year, we divide that by 12, and then that person's at $3,466 a month. So we look at everything at $3,466 a month for that individual. So in your mind, just to do like a ballpark sanity check type thing, is we got to make sure that all the expenses we can see, your housing expenses and what we see on your credit report, is under about half. So $1,733 or so is going to be half. And that's basically, the half is a good number because a lot of the Hometown Heroes, the bond programs we do, you can't have over 50% what we call debt to income ratios. So $1,733 of total everything, is going to limit what you can really purchase. And we verify it off of your year-to-date income too. So we'll be looking at your year-to-date income and making sure that everything lines up.
And what that $1,700 Mike's talking about is everything: your consumer debt, your credit cards, your car payments, your student loans, and alimony, your child support, plus the cost of carrying the property, the house, the taxes, the insurance, the principal and interest, and the HOA fees. So that's got to be. Again, you take that monthly number of that 3466 and just divide that by 2, and that'll give you an idea about how much you can, spend per month on everything.
Yeah. So I mean, what Tom's saying is $1,700. If you've got a $300 car payment, $100 of student loans, $100 of credit cards, so you have $500 of payments on top of what's going to be on your mortgage payment, and we said you can only have $1,700. That leaves you about $1,200 for your mortgage payment, or your housing payments are going to be principal, interest, taxes, insurance, and HOA. So if you're putting very little money down and you've got $1,200, you're affording about $120,000 to $150,000 purchase. So, when I'm talking to my customers, I like to just run through scenarios quickly and just see if we're in the same ballpark. Because if I'm seeing $120,000 to $150,000 purchase and they're seeing $500,000-$600,000 purchase, then we know that there's a big gap, and we've got to figure that out early. So. All right. Now, when we come down to a little bit more complicated stuff, and this is where it becomes very difficult, and you're starting to look at bonus, commission, overtime, tips, and we're looking for a 2-year history of them. If you're in the same industry, and I mean, it's got to be pretty much the same industry. If you're working on similar commissions, we may be able to count from the previous one. But even when you change businesses, you might have a higher salary and a lower commission schedule, or vice versa. So there's different nuances in there. So if we're going to count commissions from a previous job, we'd like to see that you've been in that field for a while. And I'd like to be able to see if you have a new employment contract or something like that it lines up pretty similar. And we would want to see that you're already on pace, that you're making commissions. So there's got to be a lot of what we'll call like compensating factors to allow us to do certain things if we don't have a full 2-year history of these things. So, basically what we're looking at is, and I've given the example here is, let's say that your variable income, bonus, overtime, taxes, tips, commissions, like 2021 was $12,000. All right, that's good. 2022 is $24,000, which we want. It's got to be increasing. So if you go $24,000 to $12,000, I have a hard time counting any of it. I've got to be able to show that the declining part, the 12,000, is the losses are stopped or slowing down. So if you go from 24 to 12, I need to see that you're on pace to be back up over 12 at least for me to even count 12. So that's where you can see the explanations and the stories make a lot of sense. So when we're asking you questions, it sounds like we're digging, or maybe we're being overly nosy. What we're doing is just trying to figure out what's the story that I'm going to be able to relate to the underwriters to get your loan approved. So we got 12 the first year, 24 the second year, and your year to date through 6 months is $12,000, which means you're on pace for $24,000. So basically we're going to take, 12 months and 6 months, and we're going to get $48,000, and we're going to divide that, 12, and 6 by 30. And that's what we're going to have for your variable income for the most part. So we'll massage that a little bit. We'll kind of see the story, see what makes sense. Sometimes that time frame might be a little bit less if we can explain it and it can make sense. But for the most part, that's a little bit what we're looking at.
And that goes for nurses. Nurses are a lot of, tips and or overtime. Their
Hopefully
paychecks.
not tips,
Yeah,
but
well, that's true. But although nowadays, you get tips, you'll get asked for a tip buying whatever. We won't get into all that. But anyways, nurses are sometimes their paycheck stubs are like a whole bunch of line items that we've kind of got to go through. So yeah, that's just dissecting all the line items on the paycheck stubs.
yeah. I mean, you're looking at nighttime differential, weekend differentials, and now you switched over to be Monday through Friday nurse. So, we're going to want to look at where your pay stubs are now. I mean, maybe you went to Monday to Friday and you're looking at a raise, but we have to look and see all those differentials that you're getting before. Do they still apply now?
And I know sometimes it's kind of hard to go back when we say, can you get me the last pay stub you received in 2021 or the last pay stub you received in 2022? And then, I have a lot of people, I don't know if you guys, but they'll say, oh, I already sent you my W-2. Well, W-2 doesn't break it down for us.
Yeah.
When we look at your actual pay stub, we're going to be able to see the year to date, exactly how much you made in bonuses, exactly how much you made commission. And it's got to be the pay stub that you received in that particular year. So just know that when we ask for that pay stub, it's just because we need to see the breakdown of what you got paid in each individual section, not just, your overall, because we need to know what we need to calculate. There could be, like I have one right now that I don't think I'm going to be able to, to add in his his overtime, but his bonus looks like it's right on track. So, I could use different things in order to qualify, but we do need to see the breakdown of each area.
Right.
Yeah, there's a lot of the moving parts there, just calculating the income when it comes into things like that. So it takes a few eyes, not just mine, to take a look at it. Of course, I always have somebody else or a couple of people take a look just to be sure it's correct, because it is a lot of moving parts.
Right. And what they're saying for self-employed individuals is again, we are looking for the 2-year history. And a lot of times people, especially when you start a company, you're going to take huge losses your first year. Usually your startup costs are very high. So if you start a company this year, if you don't have, it would have to be incredibly extenuating circumstances for you to start a company this year and us to be able to get you financed off of your tax returns, especially unless you start like January 1st. I mean, if you can start January 1st and you're a service-oriented industry, you're something that doesn't have a lot of overhead, and we can show some money at the end of the year, there are certain types of loans we may be able to help you with. We could also do bank statement deposits, stuff like that may be able to help you. But, being self-employed, we're looking for at least the 1 full year, and generally what we're looking for is 2 years of tax returns. Mm-hmm. So, and a lot of people too, they'll be like, oh, I just switched over. The boss says, hey, instead of me paying you W-2, I'll give you a nice raise and pay you 1099. And it sounds good, until you realize that now 1099 is self-employed. Mm-hmm. So, it just comes back to, are you helping yourself by doing this, right, or are you hurting yourself by doing this?
And the big reason with the self-employment is just because we can't see what you paid in taxes or what's going to come out at the end of the year. So until the end of the year. So when we have a W-2 employee with, we're able to see the breakdown of exactly how much they're being deducted as far as taxes and Medicare and all that other fun stuff goes. Then we're able to see exactly how much you are, claiming in taxes. W-2 is very straightforward. When we're dealing with a 1099 employee, that makes it a little bit harder, just because, we've had clients in the past that make $150,000 and then their net income at the end of the year is $50,000 because they took $100,000 in in expenses or whatever. So that's a big difference when it comes to calculating income. So just know that the 1099s we have to see the full year. We have to see all pages as well, by the way. So please include all the pages in the tax returns.
Mm-hmm. Also, when we break down, we're going to look at different things for if you're a S Corp, a C Corp, you might file 1065 LLC. You might just be Schedule C. So I know that's sometimes confusing, as you could be Schedule C as a sole proprietor. So if you're Schedule C sole proprietor, we're going to run through different types of formulas. If you're a C corp, there's different restrictions we have than if you're an S corp. All right. So, one thing, we wanted people to be aware of is we can take your mileage expenses. So if you are going to break down your car mileage and you do 10,000 miles of business expenses, we can take some of that and use that as depreciation. So somewhere near $10,000, we can give you about $2,500, $2,600 back for depreciation and add that back. But if your account wants to break it down and itemize and do a separate depreciation expense and break out your car expenses, and you're also showing that you're making the car payments out of your bank statements, we need to see that they somewhat line up. So we'll have people all the time saying that, oh, this car payment is being paid for by the business. So you got a $500 a month car payment that's being paid out of your business account, which is, $6,000 a year. But then I come over to your tax returns and I see that you're not writing off a car expense, or I've got $1,000 of car expenses. Then we can see that something's not lined up. So the stuff, again, it just has to make sense. If you're paying credit cards off out of the business or anything you're paying off out of the business, I need to see that as a business expense, because if your business is not showing that extra $6,000 a year of expenses, then we're over reporting $6,000 a year of income. That's not truly your income.
Mm-hmm.
And the things like the car payments, where the company pays for the car payments, or for some of the things on your credit report, it's got to be 12 consecutive months, not 10 or 11 months, or you skip a month, or 1 month you paid it out of your own account and the other months were paid out of the business. It's got to be 12 consecutive months of those funds coming out of the business account, period, not 11, 12 months.
Yeah, and let me tell you what, you paid 2 months in advance. You're not going to be happy when we tell you that yeah, you paid 2 months in advance, so you've got 6 payments. That doesn't count. So I need 12 payments. If you're going to pay 2 months in advance, I'm going to go back 2 years. If you're going to pay 6 months in advance, I'm going to go back 6 years or so. So, we're looking for 12 consecutive payments of you making payments, on a certain item for us to be able to back that out.
And again, all these come from guidelines. These are certainly nothing that the three of us came up with. So, all right. So, yeah, look, the paperwork gets to be a bit of a paper chase for us as well, but that's why we're asking.
Yeah, it's the same thing with rental income. Rental income is another one. There's certain ways that we calculate rental incomes. It's not just, I decided to rent my Airbnb for a certain amount of time and then here's what I'm making, especially us out here in the equestrian season. That's very nice. I've seen some very nice paychecks there with the equestrian season, but unfortunately we can't add the whole amount that you're making for, rental, where we're going to go off of, tax returns. We're going to go off, a few other things. So just know that there are, like Tom said, guidelines that we have to follow, worksheets that have to be completed in order for us to come up with our numbers. So, man, if I could inflate all those numbers that I play with, I would love to. But yeah, there's rules we got to follow.
Mm-hmm. All right, we'll pop in real quick and I just want to show you a little bit of what we go through when we're calculating.
No, not this.
I love this. Go for it. Go for it, Mike.
So let's see if we can blow this up.
I just got a stomach ache.
As you can see, we love our worksheets here.
So basically the top part is just the basics, but you can see, we've got Schedule C. So when we're looking at profit and loss from a business, sole proprietor. So on your Schedule C, we start splitting in the stuff. These are the numbers you give us. Now, depletion, a nice thing, depletion is, if you carry inventory and you've got a bunch of outdated stuff, it's no good. You go ahead and you start cleaning yourself out. You're like, oh my gosh, I paid $20,000 for this stuff. And, I'm going to sell it out of junker for $1,000. Whatever your account says, you'll have like $19,000 of depletion. So we'll see that as something you took a write-off on, but it wasn't something that really hit your cash flow. So I'll add depletion back. If you have equipment, like you bought a bunch of machines or trucks or vehicles or whatever, and let's say you have $100,000 of them, and you're able to depreciate them $25,000, we will count that depreciation as an expense. So the depreciation is an expense on your business, so you don't have to pay taxes on it. But it's not a hit on your cash flow. So we'll add depletion back. We'll add depreciation back. So that's why it's important that we see this stuff. Now that all sounds good, but then we get to the meals. You can only deduct about half of your meals depending on your industry. So if you're out there and you're spending, $5,000 a year on meals, you're only allowed to deduct $2,500 of those meals. So we see that $2,500 and we're like, we know there's another 2,500 that you're not allowed to show. So we show that. So every time you're showing meals, we're basically doubling that as an expense. So be careful when you get pushing too much on those meals expenses. And then your amortization, we don't get a lot of that, but the amortization is a good one. It counts the principal that you're paying down and the business use of a home. You can write off a portion of your home as business that we can help add back. But you can see we start adding up all your businesses stuff. We start looking a little bit at your capital gains, and capital gains is one that also gets people all the time. I sold a rental property, made $100,000. Doesn't count. I mean, if you sold a rental property your last 3 years and you made $100,000 last 3 years, you got 5 more rental properties. All right. And it looks like you're going to sell one a year. We'll look at trying to get that to count. Okay. But, basically we're looking at your K1s if you have an S Corp, and we're counting the K1s, and then we're counting the compensation that you pay yourself. And then we do a few of those add backs, and then we're pretty close to getting your income. But you can see we run into a lot of people that have multiple different types of companies. And when you start running into multiple different companies, it starts getting a little bit crazy. Mm-hmm. And as you're looking at, you got 4 or 5 companies, 2 of them are increasing in income, 2 of them are decreasing in income, so one of them you just opened, one of them you just closed. When you start calculating the income, it starts becoming a push, as far as what way to go. So you have a lot of different lenders that can count these a lot of different ways. So I would say the one thing we have is, we are very aggressive with this stuff. We've been doing this a long time. We underwrite to Fannie, Freddie, FHA guidelines. We don't have a lot of the overlays. I mean, we know when we all came out of the banks, oh my gosh, there's a lot of overlays. There's a lot of things that you couldn't do on top of what Fannie and Freddie want you to do. And it was just the protections, that some of the bigger banks are looking for. So we have the opportunity to close a lot of loans that other people aren't able to close, and a lot of it is because we also have the ability to structure them in ways that sometimes other lenders don't fully understand.
And an overlay is like an additional restriction that some lenders will put on a loan program. For an example, if we're able to do a loan, an FHA loan with a minimum credit score of, let's say, a 580, let's say a bank may not want to take on that risk. So their overlay will be, okay, well, we know 580 is okay for FHA, but we're going to make it 620 or 640. So that's called an overlay. They're putting their own conditions on top of conditions, if that makes sense. Limits risk.
Yeah. Yeah, look, I need Tom and Elizabeth. I need you to come on all my customer appointments and explain to them all the terminologies that I'm not explaining. So I appreciate it.
We need you to come along for numbers. And so you can fill out all our Form 91s that Tom and I don't like to do.
I'll pull the numbers out. They have no idea what I'm talking about. But and then you'll have to explain to them what I just said. But the thing is, I mean, and we run into it, all the time. Is I run to people. And I say this all the time is I enjoy the numbers. I could fake brain surgery before I could fake being a realtor. I mean, I don't see the numbers that way. I mean, it's very difficult. And I look here, I believe we have the smartest group of people in our office out there. And I know our support group is as good as they get. And I know when we're out there trying to structure loans and we're running into issues, it takes every ounce of our IQ power to solve the problems. And we do a good job solving them. So when I run into people that are like, oh, I'll just get my real estate license, my insurance license, or I'll just get my mortgage broker license. Everybody acts like these are part-time jobs they can just do on the side. I don't get it. I mean, I don't get it because, I do get it because we get these loans as they start falling apart every other place. But there is some value to understanding this business and the different angles to take it.
Well, it's what goes on after, it's what goes on after we take your information. And we've all had it, Tom, you've got my information there. Your job looks pretty simple. You take my name and number, and then you just see a closing. Boy, there are so many things that go on behind the curtain that we take care of, that we try to take care of, it's a lot of action. That's a lot of moving parts.
Mm-hmm. Yeah. I think also the big thing for us is just, when we look at the income and we ask for all this documentation up front, there's a reason for it. Obviously, we have all these worksheets to fill out, which we love doing. And, we have to dig into everything we possibly can dig into. And when we come up with the pre-approval numbers, because after we see all of this, I've had people, and I've shared this before in the past, that they get upset because they were quoted maybe a higher pre-approval with another lender. Well, did you give them all your tax returns? No. Did you give them all? Did they ask for your 21s and 22 pay stubs to see how much commission you can add? No, I just told them. So it's not even averaged out correctly. And then we want to make sure that you're not going to run into a bump in the road when we ask for this documentation, so we can calculate the income correctly and pretty much squeeze that orange as much as we can, to get as much as we can of income, because we want to make sure that you're going to be happy with your pre-approval. And for us, I mean, we're 100% commission. So of course we want to close these loans, and we don't want to just say, okay, this is as much as you can get. No, we want to make you happy, but we want to make it right. We want to make it accurate. So we ask for all this documentation up front just so we can do that.
All right, I got a question for Brian. He says he's 1099 and he's W-2. And one of his employers wants to switch him over to 1099, and what should he do? And my answer on that, there's two things on that one. If you're W-2 and you're going to 1099, that's a problem. Unless if I have a full year and I can see your W-2 income was $70,000, and then I have a full year of 1099 income, and I can see that, you had $90,000 of gross receipts and $10,000 expenses, you paid yourself $80,000. So we can see that you're in the same line of work, working for the same company. You went from 70-something thousand to 80,000. It makes sense. We're probably good. Now, if you've been 1099 and you're 1099 for multiple companies, 1099, you've been doing that for a couple of years. All right. And then you have one company you're working with, W-2, they want to switch you to 1099. It sort of goes in that full mix. We're not counting your W-2 income anymore. We're just going to be counting your 1099 or your self-employed income. Mm-hmm. So we're going to be looking and saying at the end of the year, when you do your tax returns, if you've been doing it for 5 years, we can probably use 1 year of tax returns. And then that could potentially help you. All right. But it's all going to depend on what your 1099 income was before, how long you've been doing it. And I don't want to say that you always have to have 5 years of self-employed income for us to count off of 1 year. We'll run through the approvals. If you have high credit, you're putting some money down, you have a little bit of reserves. Sometimes it just asks us for 1 year of tax returns, like if we run it through Fannie Mae. So we run DU. So depending on your situation, it's going to determine a little bit of the documents that are asking for. So I know we all do this when we run our loans, is we'll run our approvals a lot. And sometimes you're trying to find out what does that system want? Does it want 3 months of reserves, 6 months of reserves? Does it want a back end ratio of 44, 41, 39? Does it want a front end ratio or a housing ratio of whatever? So sometimes when you look at the combination of the credit score with the reserves, with the housing ratio, with the back end ratio, you can start finding what approval do we want? And then once you find out, sometimes you can really help your customer with what they need, because you might have gift funds from family and they're willing to help you. So if mom and dad or somebody's willing to give you $10,000, maybe $11,000 makes a huge difference on your reserves. Mm-hmm. And it might allow you to completely change the structure of what we can do for you. So again, it's a matter of layering these things and finding out what's going to help you the most.
And that's why we ask all the questions.
Yeah. And again, I know we're coming up, but I remember, and you guys remember too, being young loan officers, as you're afraid to ask questions. I remember being afraid to ask Social Security numbers. You'd ask it at the end quietly and quickly. Now we do all soft credit pulls, but you can tell the new loan officers who are afraid of that stuff. I want to know. I mean, we get it all the time. The last guy didn't ask me these questions. They didn't ask me these questions. We're here to close loans. And I want to know the story, and I want to be able to explain the story. I want to lay the story out for my processors and underwriters, and I want to get you good loans. I want to make sure we're not hurting you, so I want to know the explanation when something doesn't sound right, Yeah. And that makes all the difference in the world. And again, when the loans fall apart of their places, they come here. It's like you can almost see the questions weren't asked. And the pre-approvals that go out were based off of the customer saying, I make $100,000 a year, and the loan officer not verifying it. And it's not back on the customer. Well, the customer lied to me, because our business is understanding. They don't know how we calculate income. We know. So if we're not asking the questions and collecting the documents and getting the story, then the customer doesn't know what the income is. We know what the income is, and it falls back on us. It's our fault. So
It's easier for us to try to prevent a problem in the front end than try to solve a problem in the back end. So we're just trying to do as much digging as we can to prevent any kind of future issues. That's all.
Yep. 13 years of Catholic schooling has taught me one thing. It's always your fault.
Now get that ruler and break out your knuckles.
Always your fault. Now, real quick, we want to announce though, Dorothy Jacks. We should have brought this in the beginning, but Dorothy Jacks, who is the top property appraiser in the state, probably the most decorated, 20-something years of experience, and she's going to come speak to. She's going to be our guest at the Wellington Community Center in the upstairs ballroom on Wednesday, August 2nd at 2 p.m. So, you know, our big things are always taxes, making sure that our customers are not surprised at what their taxes are going to adjust to. I want to know, if you're buying now, what taxes are you going to be looking at in November when they come out? And then what are you looking at next year? And there's a lot that goes into that. We'll start covering that a little bit more. But also the portability is my absolute pet peeve. And portability is not being represented correctly. And customers are being cost thousands and thousands of dollars because the portability is not represented properly. So we're going to have her in. We're going to hit her with a bunch of questions. And again, she is the best, the most knowledgeable, the most decorated. And when I called them, I said, I don't want just the figurehead. I want the person who can answer the questions. At that time, I didn't realize that she's the one that worked her way up. She's the one who developed and implemented PAPA, and she's the expert in that system. So we're going to walk out of that event, and we're going to be experts on taxes and portability, and we're going to know what else they have available.
And there's a lot of other things that you can do on that website that she's going to be able to show us, whether it's, you know, looking at lots or looking at properties or looking at locations, or like Meg said, your property taxes. So no matter what type of area you're in the industry, whether you're a home buyer or we work on the mortgage end, the title company, please come and join us. It's very informative.
Yeah. All right, guys. TMFclasses.com. Sign up for our classes, 6:30 at night. We have a home buyer class, emphasis on down payment assistance. You can send any of your customers there. But TMFclasses.com. Hopefully we'll see you at one of our classes, and we definitely want to see you at our Dorothy Jacks event. Have a great week.
Thank you.
Bye.